Welcome to Friday Flows. This is where I go through the investment flows in the ETF universe. This week was a risk-off week. As you can see here, flows by asset class. Fixed income led the week over the last week, over $2 billion going in, which overall is a smaller number. As you can see, equities, people were moving from equities, commodities, and moving into fixed income alternatives. But really taking money off the table, over 481 million just leaving the ETF universe over this last week. So very much so a kind of risk off posture there. From a sector standpoint, flows by peer group sector. Over the last week, broad equities outside of the US did pretty well. Income obviously did well. Global equity broad, North American fixed municipal, income, fixed corporate. So again, just follows along what we just saw is people moving from riskier assets to fixed income, although also a good amount looking at international equities or global equities. Completely makes sense from my standpoint. Global equities have been beaten up pretty bad. From an entry standpoint, probably not a bad time to start looking at some of those areas. And as you can see, global, but there's also Asia Pacific, equity, information technology, Asia Pacific. So again, lots of movement into kind of a beat up sector over the last year. Moving on to looking at the individual ETF names of what did well last week. I'm going to start on the downside here. SPY, again, biggest fund there is, $5.2 billion, leaving that fund, which, for a normal fund that could wipe it out. For the SPY, since it's so large, it's just a small increase. But again, SPY, QQQ, really these two funds, when it's a risk off sentiment in the markets, these are the two funds where you see outflows quite the most. Interestingly enough, even though S&P 500 type fund SPY is down 5.2 billion, sorry, iShares and Vanguard's version of this fund actually took in and led the week last week. So, roughly right under $2 billion going into S&P 500 type funds, even though there's 5.2 billion leaving this particular one. I think a lot of that is just the price of SPY. Now, it's not expensive. It's 9 basis points. So compared to the universe that's out there, investment universe, it's very low cost. But for essentially the same thing, iShares is 3 basis points, and Vanguard's version is also 3 basis points. So I think investors it seems like over the last 6 months have been moving from the more expensive version to a cheaper version to essentially give you the same thing. On the individual side, again, some kind of a mix. Bad, you would think you would see more bond funds with the overall fixed income flows, but still some equity type investments within here. One I'm going to focus on here is this JEPI. Full disclosure, this is a fund that I actually hold within my portfolios. It's a newer fund. It's been around for about 3 years now, but has consistent inflows within over the last year, or actually over the last 3 years, but specifically this year has seen very, very consistent inflows, even with people kind of pulling from S&P 500 from week to week of what they think to do. This JPI has been very, very steady. So I'm going to jump into that and kind of give you an idea. So from a flow standpoint, over the last month, JPI, as you can see, has taken over $1.7 billion in flows. More interestingly is how steady that's been. Over the last month, they haven't had a single day of outflows. So that's fairly unique. I think a lot of this is just based on what this fund is. So this is a fund that is where I use it, I'll just say what I use it for, is a bit of a replacement for that S&P 500 exposure. Very fair expense ratio, 35 basis points. So not too bad there. But the biggest thing where I think it's drawing in people is its dividend yield. So 11% over 11% yield, projected yield of over 13%. The other big thing with this one is if you're looking at it from an SPY replacement, an S&P 500 replacement, over the last year or so, you've actually gotten a better return, a lower standard deviation, great Sharpe ratio, um, and a lower beta to the actual SPY. So I can see why people are using this or continuing to flow with this. Who holds this fund? Morgan Stanley advisors, JP Morgan, Bank of America. That is Bank of America, Merrill Lynch is typically what you're seeing here. So really, all the big advisor groups are the ones where you're seeing this fund being used. So advisors are really kind of driving the car on this one, it seems like. So again, just a unique fund. Was able to get these dividends yields, and I think that's again what is driving the consistent return or consistent investment flows into this fund. People want to take advantage of those yields, and now this fund is structured as a hedged product, so it is hedging its bets, and that's how it is actually getting that extra income and passing that along to investors. It's taking advantage of the volatility in the market now as volatility goes back to normal, these yields will come down, and at that point this may be not as a advantageous investment for exposure to your S&P 500. But I've heard many other advisors using it in different ways. So it's a very interesting fund. Again, it's one that I use in my portfolios. I want to take advantage of the volatility in the market. I want to get that extra yield that I can. And again, from a performance standpoint, lowering the volatility exposure to the S&P 500 and also giving you a better return in the short term anyway. So I hope this was helpful. I will talk to you next Friday, and y'all have a good weekend.